So we'll start the session now. Good evening, ladies and gentlemen. I'm Ravi Godfar from Churchgate Partners, and on behalf of Indiamart Intermesh Limited, I would like to welcome you all to the company Q1 FY23 earnings webinar. As a reminder, all participant line will be in the listen-only mode, and there will be an opportunity for you to ask questions once the presentation concludes. Joining us today from the management side, we have Mr. Dinesh Agarwal, Managing Director and Chief Executive Officer, Mr. Brijesh Agarwal, Whole-Time Director, Mr. Prateek Chandra, Chief Financial Officer, and Mr. Kushal Maheshwari, Head of Investor Relations. Before we begin, I would like to remind you that some of the statements made in today's webinar may be forward-looking in nature and may involve risk and uncertainties. Kindly refer to slide number 3 of the earnings presentation for the detailed disclaimer. Now, I would like to hand over the call to Mr. Dinesh Agarwal for his opening remarks. Thank you, and over to you, sir.
Thank you, Ravi. Hi, good evening, everybody, and welcome to Indiamart's Q1 FY23 earnings webinar. We have already circulated our earnings presentation, which is available on our website as well as the website of the stock exchanges. I'm sure you would have gone through the presentation, and I would be happy to take any questions afterwards. I'm pleased to report that Indiamart has delivered a consolidated collection from customers of rupees 254 crores and revenue from operations of rupees 225 crores this quarter. Consolidated deferred revenue increased to rupees 961 crores and paying subscription suppliers increased to 179,000, representing a net addition of 10,000 in this quarter. These numbers also include rupees 10.5 crores revenue and rupees 25 crores of deferred revenue from Busy Infotech business, as the acquisition has been completed in this particular quarter.
Sorry to interrupt, Mr. Dinesh. You can speak a little bit louder or closer to the mic. Yeah, thank you.
Okay. In the Indiamart business, growth in the revenue, collections and deferred revenue was primarily driven by improving macroeconomy as well as the result of recent growth investments we have made in product sales and servicing and building the organization. We will continue to make these investments as needed to maintain the growth momentum. Total traffic on the platform and resulting unique business inquiries remain stable at 257 million and 22 million respectively. Our 90-day repeat buyers stands at approximately 54%, which represents the continued trust on the platform. Total business inquiries delivered stood at 115 million for the quarter. As we discussed in the previous earnings call, the reduction in the total business inquiry is an outcome of certain algorithmic changes to increase the efficiency for matchmaking and improve the relevancy of RFQ being delivered to the users. During the quarter, we have completed the acquisition of Busy Infotech as well as 100% acquisition of Busy Infotech and 51% of the live keeping, resulting into the addition of accounting software segment in addition to the existing Indiamart Web Services business. We have done segmental reporting also from now on, and I am extremely positive about scaling up this particular segment over the years, leading to the augmentation of new revenue streams at Indiamart. Overall, I believe we have started off the new fiscal year on a positive note on all performance indicators, and we will remain committed to enhance our value proposition and deliver value to the customers, which will help consolidate our leadership position in the industry. Now, I will hand over the call to Mr. Brijesh to discuss a little bit more details about Busy Infotech. Thank you, and over to you, Brijesh.
Yeah, thank you. Good afternoon, everyone. The Busy transaction was consummated on 6th of April. Since then, Busy now is a wholly owned subsidiary of Indiamart. And being a subsidiary, we shifted the accounting standards from IGAAP to Ind AS for reporting the financials right from this quarter onwards. In this quarter, we delivered a billing of rupees 13 crores and a revenue from operations of 10.5 crores. Please note that because of this change to Ind AS, the revenue, PNL, these numbers may not be comparable with the previous periods. Busy also sold about 9,000 new licenses in this quarter, taking the overall licenses sold to about 3.11 lakhs. This being the first quarter of acquisition, our focus in Q1 essentially was to assimilate people, partners, and bringing the financial systems at par with the reporting standards that we follow here at Indiamart. I think we've made very good progress on all of these three counts. Now, over the next 2 quarters, we would start focusing on expanding the team, expanding the partner network, and improve our penetration in those areas where it is still very under-penetrated. We hope that the next 2 quarters, once the focus gets on these elements, we should be able to continue to build on the growth momentum that we've achieved in Q1. Now, with this, I'll hand over the call to Prateek so that he can discuss the financial performance.
Thank you, Rajesh, and good evening, everyone. I will take you through the financial performance for the quarter ended June 2022. Consolidated revenue from operations was rupees 225 crores in this quarter, a growth of 24% year-on-year, primarily due to 23% increase in paying subscription suppliers, as well as addition of rupees 10.5 crores from the accounting software segment. On a like-to-like basis, standalone collections from customers, revenue from operations, and deferred revenue were at rupees 241 crores, 213 crores, and 935 crores, representing a year-on-year growth of 42%, 18%, and 31% respectively. The company continued making growth investments in increasing manpower across functions, leading to an addition of 163 new employees in this quarter, taking total employee headcount to 3835. Consolidated EBITDA for the quarter stood at 29%. We recorded significant decline in other income from rupees 30 crores previous quarter to rupees 1 crore this quarter, primarily due to mark-to-market losses on treasury portfolio owing to significant increase in bond yields during the quarter. As most of our treasury investments are in high-grade securities and have been done with the perspective of holding 2 to 3 years, we believe that this notional loss will reverse in its due course. As a result, net profit for the quarter stood at 47 crores with a margin of 21%. Cash generated from operations during the quarter was rupees 75 crores. During the quarter, in addition to cash generated from operations, we have utilized cash in making payments for Busy and Finlight acquisitions, as well as completing rupees 100 crore share buyback and resultant tax and expense of rupees 25 crores. As a result, consolidated cash balance stood at 1,882 crores as of 30th of June 2022. Thank you very much. We are now ready to take any questions.
Thank you, Prateek. We will now begin the Q&A session. Please allow camera and microphone access if you wish to ask question once the available on your screen. Right. You may type your question in the discussion panel and we will revert to you if any question remain unanswered. Please restrict to 2 questions so that we may be able to address questions from all the participants. We will wait for a couple of seconds while the question queue assembles.
So on the traffic and unique business inquiries, they have stabilized. I don't think that there's 1-2% decline is of any meaning. And thankfully it is, because if you look at the segment side, what had happened is a lot of stress items were in demand during the COVID times. Thankfully, there are, whether it is mask, whether it is sanitizer, whether it is medical equipment, whether it is medicine, a lot of that demand has waned away. The the other part is that especially in the month of April, uh, post JFM quarter, there has been a huge price rise in various commodities, and that probably led to some tapering of demands. And but this is very seasonal, I guess. We should not have very much worried on those sides. We should be fine on the buyer side. From pre-COVID levels, we are up almost 33 to 40% on the buyer KPIs. Uh, if we can maintain these for next couple of quarters and then start to grow slowly at 10 to 20% per annum, that should be fine. Pratik, you want to add the how the people side and cost?
Sure. Pranav, as I've already spoken about, we continue to invest behind growth, and therefore have also added manpower in this quarter. So almost 163 new employees have been added. Because of which, if you see the total manpower cost, or consolidated manpower cost, it was 87 crores last quarter, has moved to 93 crores. Of which like 2 crores is on account of this increase, and remaining is on account of addition of accounting and software vertical into the business. Other than that, the cost have been going up largely in line with the customer additions, whether it is the hosting of the new customers, so all those volume linked costs. Overall, for the going forward, what we foresee is that cost will increase pretty much in line with the revenues, and we expect to maintain similar 28 to 30% business for the next 2-3 quarters. In the line, we continue to make growth investment.
Sorry to interrupt, Pratik, once again. The audio is not very clear. It's breaking up. So can you just double check connectivity at your end? Is it good?
Sure. So, Ravi, should I repeat the answer again, or you could hear only the part of that what I spoke?
So I think we heard half of it. So if you could just repeat last couple of lines.
Just a minute, Ravi, let us check the connection once again.
Yes, please. Yeah.
Just give us a minute.
Sure. So let me just repeat the answer, Pranav, to your question on the cost. What I was explaining about the cost was the last quarter. We had a total cost of 144 crores, which increased to 160 crores in this quarter. And finally, if you see the primary component of the cost is manpower, increased from 87 crore last quarter to 93 crores this quarter, of which almost 4 crores has been on account of addition of accounting and software vertical, and the other is because of the normal increase in the manpower of close to 160 odd people in this quarter which we have added. So we will continue to make these investments and continue to add employees which would be needed for the growth in the business. On the overall basis, we expect our margins to remain stable at 20 to 30% for the next 2-3 quarters till the time we continue to be in the growth investment phase.
Okay. And I also wanted to ask a bit about Busy. Busy has shown a good margins. So how should we see the growth for this business going forward? And have you started seeing any benefit, because of the integration, cross-selling, etc., which will aid growth or margin?
So Pranav, as I mentioned, the focus in Q1 for us has been that given that acquisition causes anxiety amongst people, amongst the partner networks, and we also need to, go ahead and strengthen the basic financial systems. Our focus essentially has been on doing that well. And as I said, we've come out fairly well. We should be able to, start focusing on building up the sales team in Q2, and then start to build up on the partner network, in Q3. And I think these 2 quarters, Q2, Q3 put together, I think should give us a very good view on how the business will move going forward. We should be able to come back to you with a lot more clarity once we've sailed through this initial period, where it is important to ensure that the acquisition and this whole transition actually happens very well.
Okay, sure. Thank you. Wish you all the very best. I'll come back in this.
Thank you, Pranav. A reminder to all the participants that you may use raise hand option on your screen if you wish to ask question. And please accept the invite to come on stage and ask the question. Abhishek Bhandari, you can go ahead now.
Hi, this is Abhishek Banerjee from ISEC. Again, really sorry, I couldn't hear your explanation on the cost side. Are you saying that manpower cost and outsourced sales cost are going to be in the same, are they going to be continuing the same trajectory going ahead?
Yeah, so what I said was that the manpower cost and the outsourced sales cost, both of them will grow in line with our overall customer growth. And so what we are anticipating is that as we are continuing to invest in this growth for the next 2-3 quarters, our overall margin will remain pretty stable to where they are. And after that, we will start showing some growth.
Okay, so for the next 2-3 quarters, they should remain elevated, and then it will be in line with revenues. No.
Yeah, if you are comparing them with the previous year, then obviously yes, they will remain elevated. But if you are comparing them from Q on Q level, I think as the revenue growth is now on a standalone basis at IndiaMart is about 5-6% Q on Q. I would say that similar increase you should assume in the manpower cost and the sales cost. So that we will maintain about similar 30% EBITDA margin.
Got it. So, do you share any numbers on
employee cost will increase in that manner. However, can we expect any advertisement revenue also coming through into the company to increase our traffic share? And can that impact our margins as well in the next year or going ahead as well? So that are the two questions from my end.
And let's first talk about product and
Sorry, Dinesh ji, your voice is not audible. Once again.
Ravi, is it any better now?
It's much better. Let's start once again.
Okay. First, talking about the product and technology employees. In the last 2 years, we haven't hired any product and technology employees, and we had given offers to the campus in this entire last year. And people had started to join as a trainee from January, and most of these people they completed their examination and became permanent in this particular quarter. And that's why you are seeing a step function jump in the employee count. So we have actually beefed up our product and tech team, knowing that the market is going to be tough for product and tech. We need more people. We have expanded multifold into different products. As you can see, our CRM has become quite mainstream, and we are also trying to do experiments around various more engagement features on the relevancy improvement, category-based improvement, as well as trying to experiment more on the payment and credit side. On the Busy also, I think 180 total employees have been added.
There are total 181 as of 30th June. But the entire addition of product and tech that you see here is on account of people who joined Indiamart. Yeah, this is not on account of people like this.
The second question was around the margin. So, people will.
Sorry, Dinesh ji, not audible. Sorry to interrupt once again. So maybe you can now start answering the second question, please.
Yeah, the second question was around margins. So as we guided that margins will remain in the range of 30-odd%. As we are adding these new customers are added at the lowest ARPU in the entry level segment, in the silver monthly and silver annual. As these customers will move up the value chain over the years or so, that will improve the margin. So as the customer base increases, the margin typically are lower. As the customer moves up, becomes older, then the margins improve. As you can see, the top 10% customers ARPU is around 220K, and top 1% customers ARPU is around 790K. However, the overall ARPU is about 46K, while the silver monthly ARPU is about 2.5 thousand per month, which is about 30,000.
Sure, sir. So just a follow-up on that. Just wanted to understand that can we expect Indiamart to spend more on advertisement as well in coming years?
Yeah, as we have always guided, if at all we decide to do any advertisement, it will be to the tune of 30-40 crore rupees per annum. However, we feel that last couple of years there has been more buyers than sellers. We are trying to build more supply on the platform, more responsive supply, more. So I think current year or so we don't plan to spend anything on the brand building advertising for buyer acquisition. Our 100% buyer acquisition remains organic, and we believe that it will remain so for the next year or so. If at all there are any advertising plans, we'll let you know in advance.
Sure. Thanks for the talk.
Thank you, Anmol. Next question is from the line of Ratik Gupta, Guardian Asset Management. Ratik, please go ahead.
Yeah. Hi, sir. Good evening. So my first question is on the supplier front. So although we are seeing a 10,000 increase in the supplier front for the this quarter, so do we have a number if we have lost any?
This is the net added, sir.
Yes, so if you are asking about the churn, we give the churn numbers quite frequently in every call. The top gold and platinum customers, the churn remains less than 10% per annum. In the silver annual segment, the churn remains around 25% per annum. And in the silver monthly segment, the churn typically.
Sorry, sir, your voice is breaking out.
As I said, the churn in the gold and platinum segment, the churn remains at less than 10% per annum. In the silver annual segment, the churn becomes about 20 to 25% per annum. And in the silver monthly segment, the churn is about 5% per month.
Okay. And my second question is, sir, on the current scenario, what we see is that the focus has been towards the manufacturing sector and the product sector. So are we looking forward to move towards the service sector as well as IndiaMart service?
Yeah, I mean, on a large macro side, dividing that into manufacturing, I think many service providers are our customers also. We go by small category by category, so business services, construction services, that kind of it. And I think we continue to expand into more and more categories to monetize better, and we will continue to do that. But are we going to go into B2C services? I don't think so. We will continue to remain B2B services.
Not specifically to B2B or B2C, sir. I'm talking about the services, the service segment sector. As we are focused towards the manufacturing sector like industrial plants, machinery, or the construction or the machinery parts, are we focusing on the service segments as well? Supposedly IT services or the financial services segment.
Yeah, not much on IT services and financial services, but you will see software, many software companies. You will see many call center companies. You will also see many consultants. You will see many chartered accountants and logistics service providers, transportation, that kind of services.
Okay. Yeah, that was my question. Thank you, sir.
Thank you, Ratik. Next question is from the line of Amit Chandra, HDFC Securities. Amit, please go ahead. Amit, please unmute. Yeah. Hi.
Yeah. I'm audible now? Yeah.
Yes, you are audible. Please go ahead.
Yeah, sir. So my first question is on the on the customer addition that is mostly on the monthly like subscribers. So what percentage of the monthly subscribers get converted to maybe a long-term engagement with us? So if you can provide some colors on that, whether how many of them that we add that remain with us, because you have mentioned that the churn is coming down. So what kind of impact it is going to have and
Maybe Amit, you can turn off your camera. It will save some bandwidth and repeat your question then.
Am I audible?
Yeah, it's much
Yeah,
better.
you're audible.
Yeah. So, my question is on the channel partners. So, how the channel partner economics actually work, in terms of commissions that we're giving to channel partners, because, what I'm seeing is that, as you have mentioned, that the cost will actually go up, in line with, the supplier addition. So, is it that most of the sales that is coming, or sales, in terms of customer additions that is coming, is mostly through the channel partner ecosystem, or our in-house sales is also adding, so
Yeah, as I said earlier, about 50%, more than 50% of the sales currently come from in-house sales channel. And our endeavor is to keep it at 50%. And the cost on the employee front will rise because our cumulative customer base is increasing, and we need client servicing and renewal and upsell employees, and those are 100% in-house employees. We have not yet tried the channel partner there. We will probably start to think about those, especially in the tier 3 towns. And how the commission works is a very very standard DSP mechanism which you see in the banking sector, or which you see in the telecom sector. So, it is calculated based upon whatever is the cost and whatever is the.
Sorry, Dinesh, your voice is breaking up. Yeah.
So the commission on the sales is to the channel partners are per sale basis, and is arrived at based upon the historical cost we have had at Indiamart.
All right. So I think Amit have left. So we'll move on to the next participant, Manish Gupta from Solidarity Advisors. Please go ahead, Manish.
Yes, thanks for the opportunity. I'm sorry, I'm coming back to a question other participants have also raised. You made a statement, I hope I've understood that right, that employee cost will stay roughly proportionate to how your revenue increases. That's kind of, very counterintuitive because of two reasons. One is, one would expect that there would be some productivity of the sales force over time. And secondly, you do mention that people come in the lower tier and then they upgrade to higher revenue per supplier as they move into the gold and the silver and the gold and the platinum programs. So it's very counterintuitive why your employee to revenue ratio just for the standalone business should not decline over time.
Yeah, see, can you see the current slide on the up there?
Yeah.
So on a long-term basis, you are right. On a long-term basis,
sorry, Dinesh, I can't hear you. Dinesh, it's a very bad line. One request is just to see whether this is an issue of bandwidth or it's an issue of the software platform you're using. Because this is really a terrible line. This one has been barely able to understand anything on this call.
Are we audible now?
Yes, it's audible now.
It's a bandwidth issue. We have used a new conference room. I think there is something wrong there. So
Yes,
if you can see the slide, on a long-term basis, the margins will improve, and they have been improving. It is only in the last 2 years where the margins had gone exceptionally high because we have not been investing in growth.
Sorry to interrupt, Dinesh ji. It's a very bad line. Not able to hear you at all.
The problem is not my voice.
Yeah, no, Dinesh, I think it's just the conference room that aap keh rahe the. May I offer a suggestion that we reschedule this call? Because, we get to talk to you only once a quarter. And I think there were some very interesting questions that people asked. So if it's not too much of a bother, Dinesh, could we reschedule the call and do it again?
Yeah, we'll talk about it. We'll internally and see if
Yeah, otherwise,
what
I'm
is.
happy to do a call offline with Pratik or something.
Yeah,
So, but just as I
that's
understand,
fine.
yeah, what I heard you say was that over time, the reduction in employee benefits, we should continue to see that over time. Is that what you said?
Yes, only for the next 2 quarters or so, it will not. It will grow in line with revenue.
Okay, clear. Thank you. Thank you.
Right. So we'll move on to the next participant then. Amit, are you there?
Hello,
Yeah.
can you?
Yes, Amit, we can hear. Please go ahead with your question.
Yeah. So, no, actually, my line got lost. So,
Yeah.
on the cost part of questions have been, asked on the cost aspect. But so the adjusted EBITDA margins that you have given, so that is excluding the ESOP cost, if I'm not wrong. And, if I exclude the ESOP cost and if I exclude, the acquisition impact, then the margins come to around 33%, right? So what we are saying here is that the investments that we're planning and we're targeting 30% margin, because the margins of like busy is on the higher side, right? Typically it should have a you know uh, you know like positive impact on the margins. So how do we see the cost aspect, and also the ESOP cost? What would the ESOP cost for the full year, if you can give that, and also on a standalone basis, how the cost will move up or it will be stable at these levels.
Sure. So, one clarification, when we said about 30% margin, that was on EBITDA and not adjusted EBITDA. So that was actually including the stock comp expense.
But you can tell what is the ESOP.
Regarding the ESOP projection, or as to how do we see this cost. So this cost is primarily on account of the ESOP that we issued in the month of January. So for first year, this cost will stay high. For the next 2-3 quarters, it will stay high. And after that, depending upon the amortization schedule, it will come down slightly. So the 7 crores per quarter will continue for next 3 quarters.
Okay. And my last question is on.
On the busy side, busy is a very new and very small business as compared to the overall business, and we will make investments in product and technology and sales. So busy, while you are seeing the current profitability as 40-50%, I think our immediate target on busy is not about margins, but about expanding the sales and making the product available on mobile and cloud and all those things. So I would say that that 5 crore rupees would not have a larger impact on the operating margin on the consolidated basis.
Yeah. No, so again on the busy side, sir. So obviously, the run rate that we are showing, it's indicating around 40 crores like full year for.
Sure.
The line is really bad. We're not able to hear you. So, most of the answers we're not able to.
Maybe try Brijesh now.
Correct. Is it better now, Ravi?
Better. Please go ahead.
So Amit, on a like-to-like comparison basis, if you look at last year, the revenues were based upon the billing. The billing in Q1 is at 13 crores, which means it will be at a run rate of about 52 crores, higher than the revenues which were there last year. Now, having said this, when we look at the focus that we are having on the busy business, as I mentioned, the first focus is to make sure that the people and the partners, they continue to stick with the business and do not get alarmed by this change in management that has happened. We would be able to go ahead and start focusing on growth from Q2, Q3 onwards as we start to invest behind growing the team and growing the partner network. In the last call, we had mentioned that the priorities for us in this year would be one, to double the rate of growth. Generally used to be about 10-12%, take it to about 20-25% in this financial year.
Yeah. So just a minute. Huh? So could you just repeat the last statement?
Yeah. So as we had shared in the last quarter, our top three priorities in this financial year would be one, to double the rate of growth from the erstwhile 10-12% to about 20-25% in this financial year. Second is to increase the overall number of new licenses which are being sold, because that would be forming the foundation for accelerated growth in the years to come. And third would be to go ahead and invest behind building the team and improving the overall awareness of the product so that we can ensure better penetration in markets all across India. So these would be the three priorities in this financial year for us.
Okay, sir. Thank you and all the best for the financial year.
Thank you.
Thank you, Amit. Next question is from the line of Ajay Modi, Piper Circa Advisor. Ajay, please go ahead.
Thank you, Ravi. Prateek and Dinesh, quick question. So, are we saying that our quarterly employee plus outsourced manpower expense run rate is, which is now roughly about 120 odd crores, will go higher further? So that's my first question.
Yes, as we discussed in the past, that since we are adding manpowers across functions, this cost will go up in line.
Sorry to interrupt once again. So let's wait for 5 seconds or so.
Ravi,
No,
is there an option if you can move to an audio instead of video?
No, you can try and turn off your video, Kushal. Maybe turn off your video and let's see if it is better.
Yeah, we've switched off our video and we'll continue with the presentation.
I think it's better. Let's please go ahead.
Yeah, I can hear
Maybe
you.
is this better?
Yeah, it's better. Kushal, your presentation, it's not visible at the moment. So if you can just share your...
1 minute.
Yeah,
is it visible now, presentation?
Visible now. Yeah.
Thank you.
Please go ahead.
Okay, so coming back to the question on the employee front, as we discussed recently right now, that we will continue to add people, and as the people will get added, this cost will increase. However, as a percentage of revenues, it's likely to stay same because the revenues will also grow quarter-on-quarter.
Understood. But then Prateek and I think Dinesh ji can come in here. So our expenses, which were largely flat, we did not do any large hiring, didn't increase team size back in 2020 and 2021, which we've started doing now. My question here is, shouldn't we be sweating these employees more? Shouldn't the growth rate be higher? I mean, for example, you just said that target is to do 25% kind of IRR for or CGR for busy, but for a 40 crore sales, 25% is growth is about 10 crores, which is way too small for a company of our size, right? So what my understanding that I'm trying to seek here is, what is stopping us from higher growth? Right now we are at 179,000 active users in the IndiaMart platform compared to 7.2 million storefronts, which is roughly about 2.5% paid to overall subscribers. So what is, I mean, if we have money, if we are spending, if we are hiring, what is stopping us from saying that, look, I will drop my ARPUs lower and I will increase my subscriptions far higher? I mean, we are the market leaders. So why are we not cleaning out this market completely?
So let's look at the leading indicators of the growth. So there are two leading indicators of the growth. One is the number of customers, and the second is the collections in the. So if you look at FY21, we neither added customers nor added any collection. So if you look at the collection of FY21 versus FY20, it was a flat collection, and if you look at the number of paying subscribers, it was a flat year. In the FY22 also, the first half was marred by COVID. It is only whatever growth has happened in the second half of the year. Now, if you look at the current trend, so from we have tried to double our customer growth from 20,000, 22,000 per annum. Now we are saying that we will go to 35,000 odd per annum at about 8,000 to 9,000 customers per quarter. So I think we are investing behind growth. Now, why can't we go even higher? That limits my ability to manage. And as we and to people's adoption of internet and businesses adoption, I think we remain committed to a profitable growth business. As we said earlier, so even before the pandemic, our revenues used to grow at 25-30%, cost used to grow at 15 to 20%, and that is what resulted into margin expansion. I think for now, given that we have not done any investment in the last 2 years, currently the margins will remain flat at around 30%. However, as we achieve a higher trajectory, we will again start to focus on margin expansion.
Understood. Quickly, Dineshji, so you said that why can't we go higher? That limits your ability to manage. My question is that, look, for example, we acquired Busy. Busy has a revenue of what, 40 crores. I mean, for doing a 25% growth, 10 crores doesn't even move the needle for IndiaMart as a platform. Specifically for Busy, why are, at what point would we expect a little more aggressive growth here?
As I mentioned, we would be able to come back with much better view on the overall Busy business from next year onwards, because we would have seen through this entire time of integration and assimilation of people and partners, and we will build visibility on acquisitions and revenue growth going forward.
Okay,
I think I've already repeated this multiple times during the Busy acquisition process itself, that first year my entire focus would be to make sure that we do not go burst with the acquisition. So I think the most important factor is that this year let us focus on retaining the revenue, retaining the employee, retaining the partners, retaining the customers, understanding the business inside out. And then next year onwards, let's put the focus on growth.
So then if I were to ask you, what is a 3 or a 5-year view with this business? I mean, what size should it become? Not can, but what size should it become?
I've given a long-term, my own expectation that over a period of time, over the next 10 years, can this become a 500 crore business instead of a 50 crore business.
Okay. Thank you.
Thank you, Ajay. Next question is from the line of Vivekanand. Vivekanand, do you have a follow-up question?
Yes, Ravi, I have two follow-ups. So one is on the investments. There are several startups where IndiaMart's stake is less than 20%, like M1 Exchange or Bizome. Do you see an opportunity to increase your stake in these companies anytime soon? Also, in the next 12 to 18 months, how do you envisage the utilization of cash? Will there be any major new investments or material follow-on rounds that you expect? Second question is on the shift to weekly salary payout. Is that having any bearing on attrition? Is there anything else to call out in terms of attrition? Thank you.
So on the weekly salary, it has been received very well, and I believe that the kind of things that we are listening in the market about attrition, we are not that badly affected. But I don't think this can be the only reason for. So maybe if our attrition, if we had a monthly salary, the attrition would have been 1% higher. So I think everything adds up to the attrition. On the minority investment side, you are right that we wanted most of the investments to be around 26%. In many cases, we probably either found it too early to go 26% or the availability to be less than 25-26%. And so in Bizome, over the time, we have increased our share. In Vyapar also, we started with 26, now we are at 27.5. In Logistify also, we started with 10-11%, now we are at 15%. So as and when we continue to assess businesses and as and when there are any things, we will continue to look for opportunities to increase our size. In 9 out of the 14 investments that you see here are about 25% or more. Specifically about M1 Exchange, it's an RBI controlled regulated entity, and no single entity can take more than 10%, being a RBI controlled banking exchange. So we are only allowed to take up to 10% there. We already have 7.7, and as and when we will find the opportunity, we will increase it to 9.9%.
Okay, thank you. Just one last follow-up. Any updates on Vyapar and how the offtake has been and how you are thinking about it now alongside Busy?
Both operate in a very different segment. While Busy operates at more of a small and medium businesses, Vyapar operates mostly at micro and small businesses. Vyapar, less than 50% of the Vyapar customers are GST registered businesses. In Busy, I think more than 80% or 90% customers are GST registered, and not only GST registered, but I think with good turnover. So Vyapar and Busy actually solving very different needs for very different customer segment. Busy probably is more to do with tally kind of a market, whereas Vyapar is very self accounting software or DIY accounting software.
All right, thank you. Best of luck.
Thank you. Moving on to next participant, Ajay Modi. Do you have a follow-up question?
Yeah, thanks, Ravi. Dineshji, quick one. We have a very large exposure now to accounting. We have live keeping, real books, busy, and Vyapar. Can you just throw some light on what is your long-term thought process with all these, and while I understand which pieces of the puzzle do they fit in, uh, what are we looking at from a longer term? I mean, what is the opportunity size that we're looking at?
So opportunity size, if you look at today's market, about uh, about 2,000 crore is what the customer pays. About 1,000 crore is what the company's revenues are, because most of the companies have been working on box model, box license model, and on the transfer pricing model. So from the customer side, and I'm not talking SAP and other, only the small business accounting. So that's about 2,000 crore rupees market, and this market has grown rapidly in the after GST. In the year GST year, this market actually tripled from being at 300-400 crore market to 2,000 crore, and ever since then it has been growing. And now with mobile and cloud, we believe that this market can become $1 billion market over the next 10 years or so. Out of that, if you look at major market share has been with Tally, and Tally has been primarily an accountant-led desktop-only accounting software. That our take is that is going to change. Vyapar came from a mobile-only and DIY accounting, and now slowly started to offer a hybrid cloud onto desktop as well as mobile. Real Books is a multi-branch, multi-location, simultaneous accounting system. Busy, though it has a historically box-based pure desktop model, but I think our vision is to convert that over a period of time into a mobile and multi-location cloud-based model. So we believe that this is a good, and anyway, it has all the good business models like stickiness, customer stickiness is there. It has a recurring revenue stream. Earlier it was in the name of AMC or upgrades. Now I think over a period of time, as we have seen, most of the software is moving into a recurring revenue system. I think we are looking at currently 1 million businesses are within Indiamart ecosystem are using our software. So Vyapar is being used by almost 500,000 people. Busy is being used by 3 lakh licenses have been sold. Many people have 2-3 firms being operated on the same license. And similarly, Tally, as per published resources, are about 5 million users on Tally. I think this market is going to only grow. It's been there for almost 50 years now. This market is going to grow only.
But have we, are we already seeing the kind of adaptation here, as in from a expert point of view, what you would have expected in terms of adaptation? Are you seeing that already?
So in the Vyapar, when we first saw Vyapar in the year of somewhere in the middle of 2019, it had less than 10,000 customers. Now we are just 3 years from then. If it's July 19 versus July 22, there are already 120,000 odd customers. So they have added 1 lakh plus customers in 3 years.
Okay, that's all from my side. Thank you.
Thank you, Ajay. So I'll now read out a couple of questions from the discussion panel. So first question is, do you charge commission as a percentage of sales from your platinum subscribers to understand the ARPU of 7.like subscribers?
No, we don't.
Okay. And now moving on to the next question. What is the registered supplier versus paid supplier ratio? And what is your current conversion rate from the free supplier to the paid supplier?
So about 1,70,000 paid customer and about 70 lakh free customer. So that makes about 2.5% of the customer base which is paid. If you look at worldwide classifieds, they typically have anywhere between 2 to 5% penetration. Whether you look at Alibaba or whether you look at many other 2 to 5% penetration. In our case, being B2B, in certain we look at GST data. Out of the GST data, about 12 million people. There are about there should be about more than 1 million possible customer base over a long period of time.
Okay. So just a follow-up, sir, on this. What would be the strategic focus area, or how do you plan to improve this conversion? Apart from advertising, what would be the key drivers to improve this conversion rate?
We continue to expand, make it easier for people to do DIY, as well as continue to expand our touch points, whether it is online, telephone based or field based, or now we have expanded through channels also. So we will continue to do that. I would say one of the most important factors in this free to paid conversion is people's own ability to take out value from an internet-based business. There are within the same category, within the same geography, there are some people in the same geography, same industry are able to take out better value from Indiamart, and some people are not because of the way they are adopted to internet. And as and when more and more people are adopting, more and more businesses are adopting, that is also going to improve over a period of time. We have seen it's been only 5-7 years when this mobile phone has become quite popular. And I think it will continue to improve over a period of time.
Thank you very much, sir. So maybe now I would like to hand over the call to you, for the closing remarks.
Ladies and gentlemen, thank you very much for joining our Q1 FY23 conference call. I'm sorry about the internet disturbance that we have had. In case you have more queries, please feel free to reach out to our investor relations department, and they will be happy to answer your queries one-on-one. And we will try to have a better tested connectivity next time. Thank you very much. Have a great day and have a great weekend.
Thank you, sir. Thank you, all the participants. On behalf of Indiamart, we now conclude this webinar. Thank you. You may disconnect your